I request all to please rise for our CA motto song.
Yeshasupteshu jagrati Yeshasupteshu jagrati Kamam 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 Pursho nirvimana Tadeva shukram Brahma Tadevamritamucchate Tasmin lokaha shataha Sarve tadunatyati kashchan Etadvaita
Please be seated. UFO video will be played.
Arthashastram, Dharmashastram cha, meaning economic principles, earth, and ethical considerations, dharma, which are central to the work of accountants. The entire world is deliberating about the impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the work, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOPAC, proudly presents before the World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhoomi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025, at the magnificent Yashobhoomi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhoomi, New Delhi. For more details, visit wofa.icai.org.
It's my pleasure to introduce AJAY Rotti. He is a founder and CEO of Tax Campus Advisor Private Limited, a boutique tax consulting organization. He was prior to this, he was a partner at Durav Advisor LLP and co-founder Ajay was a partner in international taxation at KPMG. He also previously worked with BMR Advisor and EY. Ajay has more than 20 years of experience in the tax and regulatory arena, has considerable experience in corporate tax, transfer pricing and international tax area. He has advised a number of large multinational and large Indian companies on a range of direct tax and regulatory issues. He has also represented various multinational Indian companies before the income tax authorities on corporate tax and transfer pricing assessment. He also represents clients before Income Tax Appellate Tribunal. He is a member of ICAI and holds an advanced diploma in management accounting firm from the Chartered Institute of Management Accountant UK. He is a gold medalist in BCom and was a Bangalore University topper in cost accountancy. He is a regular speaker at conference and seminar and also authored several articles in leading business newspaper and tax magazine. Thank you, sir, for your presence. I request Delhi Babu, sir, to present shawl and memento to our speaker. It's my pleasure to introduce Pramod Srihari, sir, is a fellow member of ICAI and Insolvency Professional, registered with Insolvency and Bankruptcy Board of India. Is a partner in a Pramod Darshan located at Bangalore. The associate partner of Optimum Research and Research Advisor LLP. Is a past president of Karnataka State Chartered Account Associate. Has served the post of Vice President, Secretary, Treasurer and Executive Committee of Karnataka State Chartered Account Association. He leads restructuring, turnover and corporate accounting solution. Closely worked with an organization in the sector of manufacturing, information technology, biotech, medical technology, social, capital and financial market, logistics. He has presented paper across various professional forums, contributing articles to professional journals and business newspaper. Visiting faculty at Chris Jain International and New Horizon College, is founding trustee of PLR Kalasangamam, which encourages Indian arts and music. Thank you, sir, for your presence. I request Manish Jain, sir, to present shawl and memento to our speaker. Hand over to the speaker.
Good afternoon, members, and thank you SIRC for inviting me to speak on a topic which is still relevant after 8 years after its inception. The first thing is there are two topics today which we are speaking. One is on an IBC, the second one is GCC. I mean, they both are still not clubbed. If you have seen, both are interconnected. They are not interconnected, but they are two different independent topics. I thought it is very relevant today to talk about business closures and how IBC is a means for economic growth. Now, before even I raise the stage today, there was a WhatsApp message which I got, and there is a company in Noida which is near Delhi, which is, I think the name is called Yes Madam. You all can type it. They have sent an email to all their employees stating that they have taken a survey of stress of all the employees, and sadly they saw that there is a lot of stress, and they have sent out all those people who have marked as their, it is under stress. So they have sent those people who said it is very stressful to work. I mean, we are living in such a world where taking stress is so relevant. Now this you have to see from the background of how businesses are adapting themselves to the ever-growing challenges. Now I wanted to name my topic as business exit. But moment we name this as business exit, everybody would say probably I am giving some topic for the co-founders because I am giving some ideas for exit. No, I am not giving any ideas for exiting the business. We are only saying how do we close a business which is formally. Because we all presume that starting business is a very interesting and a very positive sign and closing is a very negative sign. But if you see the growth of India's economic activity from past 8 to 10 years, the first activity was incorporation, which is they wanted to reduce the time to incorporate the companies from months together to days, correct? And then started schemes which encourage people to come into the businesses. You can take the example of Mudra loans, you can take the example of incentives which they offered to the startups as means of tax incentives. These are all the encouragements they wanted the entrepreneurs to come inside and start a business, correct? And then they offered some of these, all states, Tamil Nadu has it, Karnataka has it, all the states offered incentives, grants for them to start the businesses. So this is about start. While it was getting operational, that is when the management and it is getting operated, they wanted to simplify direct tax, they wanted to simplify indirect tax, they brought in GST. So while it is start, at the time the operations, they amended all the acts which was getting, which was formalizing the sectors. They brought in UPI, they brought in fintechs, they allowed lot of changes there. They also amended the competition commission so that even the young businesses can also compete with the larger ones. While start was there, when managing was there, there is no law in India where exit was allowed. If you do not correctly talk about what an exit is for an entrepreneur, you are putting him into a conundrum of uncertainty. Correct? Moment you put him into an uncertainty, nobody would try to experiment with a new business. We are in an era where we need to encourage taking risk. And how do you allow them to take risk? Is not to put a taboo that they are a failure. So allow them to exit from the business if things don't go right. Correct? We all know that 90-95% of our startups fail, but we still encourage them. Not that we want failures, but what we want is the successful entrepreneurs, but not taboo them as an exit. So India got in insolvency and bankruptcy code as one of the means for those businesses which could not adopt to exit the business. And it's one of the excellent economic law which allowed the businesses to exit and then allow the economic engine in the country to run. Okay, in that background we have to see why it is allowed. I'll go further. I mean, this is what I thought. In this context, we have to see how the insolvency and bankruptcy code is. Yeah. There was an exit clause, if you remember, in Companies Act, which came in quite as old as 2017 or 18, which we call as strike-off. If you remember, strike-off was a very simple means for the companies to get out of business. It is a very simple way to say that if you are not conducting any businesses for the past 2 years, apply for strike-off, and the ROC would go through the documents and then remove your name from the register of companies, whatever they maintain. But technically it still is not dissolution. It is just still a strike-off. So there were many cases where the businesses had liabilities. They could not exit the business. You can't say you have a liability in the balance sheet and then you apply for strike-off. It will not be accepted. Section 8 companies couldn't go for strike-off because that was not allowed under Section 248. Okay. What if there are assets in the businesses? How do you exit those businesses which have assets in it? So imagine there is a balance sheet. If there is anything on the liability side, you can't exit that business because you have an obligation to pay. You don't want to exit a business which has asset because there is an asset in it. You can't apply for strike off. They will strike off, but your asset is also strike off, which you don't want. Section 8 companies were not there. So while strike off is a very easy administrative mechanism for those businesses which are still not doing business for the 2 years to exit, but it was not the right way for the companies to exit. So there was a difference between this strike off and dissolution. So do not think dissolution and winding up is equal to strike off. They are not same. So what are the main conditions they put? 2 years of no business. You should have paid all the obligations. More importantly, recently what they brought in was, if you want to go for a strike off, you should file all the annual accounts, audited annual accounts, and file your annual return up to date. That means you can't keep annual accounts and annual return pending before you go for a strike off, which is not allowed. So, but there are circumstances where businesses don't do well. They don't have money to file. They can't file. There is litigation. Okay. Some of the failures in businesses are so huge that they did not fall. Together with them, even the auditors have fallen. Take the best example of Enron. When Enron had a fall, with that who fell? Even the auditors of that fell. So some of these companies are so large that they also pull along all their vendors are also along with them when they fall. Correct? So strike off was a very easy mechanism. It was not for those large companies. And there are some companies which are regulated by other regulators, like NBFCs are there. There are IRDAI. There are some companies which are fintech companies which are with RBI. They can't go under strike off. They are not allowed to go. Strike off is not allowed for such companies. Okay, so these are the problems of strike off, but it isn't very easy mechanisms. So who can apply for a strike off? Both. ROC also can do a strike off suo motu by himself, and a company which wants to be taken out of their register of companies can also apply for it. So both the circumstances are there. But there is a small difference. If it is for an ROC who has to apply, there are conditions. That is, a company has failed to commence its business operation within 1 year of incorporation, or if they are not carrying on the businesses for past 2 years, the subscribers to memorandum have not paid their money, subscription amount. And the last one is the company is not carrying on any business operation as revealed after the physical verification. So these are the 4 conditions. But if a company wants to apply, it is very simple. 2 years of no operation, no obligation, no asset. That's it. Now, strike off, if you see, it is so simple. Have a board meeting, prepare the form, apply for it. There is some prescribed fees which you have to pay. You will have to pay that fees. Probably it will be, the name will be struck off. But is that sufficient means? We will come back to this question a little later. Now let's see circumstances of business failures. This is a very, very, very important topic which we all have to dwell, because if we want to encourage somebody to start, we should also encourage somebody to exit as well. So there are 3 circumstances which we have put. What is the first one? Those cases which are avoidable. There are cases, business cases, which are unavoidable failures. The third one is called as intelligent business failures. What are those avoidable business failures? Some failures are perfectly avoidable. If you see what happened to Paytm when RBI had to cancel their license, it was a perfectly avoidable failure for Paytm. Correct? I mean, Paytm could have avoided it by properly following the law. But what happened to Jet Airways? Jet Airways was a highly competitive industry. In spite of their best efforts, they could not hold themselves to the business. They could not hold down their ground. They have to lose their business. Is that avoidable or unavoidable? It's perfectly unavoidable because business is getting more competitive. It can get more competitive. So there is a second circumstances. The third one is intelligent business failure. That means some of these products are not even tested. They come to the business to test the product. If it is a hit, they survive. If they lose, they don't survive. All the startups which are there in the current industries probably will fall into these intelligent business failures. Like, who ever thought that some of these companies like Dunzo, Porter would even exist 5 years back? Correct? They were all just testing the market. If it succeeds, it succeeds. You know, you imagine even the Netflixes, some of these hot stars. We never knew they will exist, but today they're existing, correct? So we have to fit into these, three type of failures where they into. In whatever be the reason, we cannot say that every business failure is the failure of an individual. And that is why we say IBC is a law to legitimize a failure. We don't encourage failures, but we are legitimizing something which is already failed. Okay? That's how it is. I said you, some of these auditing firms also have failed. With Enrons, Andersons, they closed their offices. Probably now they are back, but they closed when the business failed. The famous case in the startup world today which is buzzing in the headlines is Byju's. Yeah? Byju's is today facing one of its toughest challenge in NCLT Bangalore bench, wherein their existence of business itself is questioned. If they don't pass through this process of NCLT, they will probably move into next stage, which is called as liquidation. They'll have to close their business. What was once celebrated, not once, 3 years back they were celebrated with $22 billion valuation. Today, not even $1 billion it is valued at. Okay? So the one question which always people feel offended is, should promoters be held responsible for all the failures? How many of you believe that promoters have to be held responsible for all the failures? We can't hold promoters to be held responsible for the business failures. It happens just as it is. And that is why I say we have an IBC. And on the right side, I have given all the reasons where things can go wrong. If you can see the poor finance management, all of these. And none of these are related to finance. They are all related to business. The business failure ultimately impacts the finance failure. Not every finance failure will come back to business, but every business failure will eventually go to the finance failure. So finance is an indication, is a symptom of business failure. Sometimes some of the roaring businesses, they are failing. But how you will come to know, the first symptom is found when there is no working capital. The first symptom is found when there is no revenues in the profit and loss account. The costs are bulging. The EBITDA is dropping down. The symptoms are found. It is like what you call. It is like a BP or a diabetes checker for a business. That is how we evaluate it. So when IBC came, they had few objectives in their mind. What is the first objective? They said that the purpose of the code is not for the companies to exit. Nowhere if you see exit is written. The first objective is resolution. Means make the best effort to resolve the problem. That is the first objective of an IBC. I'll come when will we go to IBC. So if the company is under stress, I'll repeat the word stress repeatedly throughout my presentation. Moment I say stress, which is financial stress, that means company is not able to pay anybody. Some people, they are not able to pay their loan, they are not able to pay their EMI, they are not able to pay their creditors, they are not able to pay their salary, they are not able to pay the statutory dues. Any of the non-payment is a symptom of stress. And if the stress is more than 1 crore, they can be pushed into insolvency and bankruptcy code. Don't worry, we will go through each of those processes separately. But what is the intention of the objective of the IBC? The first one is to resolve. It is to resolve and to get the maximum value out of it. If we, for example, Byju's is now entered into the process of IBC. It is into CIRP. There is a process called as CIRP. It is into CIRP and NCLT bench. What's the first objective? To get the best value for Byju's. What is the best value? It is based upon the circumstances. It depends upon the case. Each case is separate. But get the best maximum value which it could ever get. We do not know how much is the value, but get the best value. So nowhere we are saying closure. And if you see the third objective, it is time bound. Why do we say it is time bound? It is because only when there is a resolution which is time bound is where the maximum value comes. If people go in a very relaxed approach, the value proposition will not come. What is value today? We call it as time value of money. We all have learnt it, right? What is value today? If you don't resolve it in the next 6 months, may not be the same value after 6 months. Probably the value is depleting downwards and downwards. So it has to be faster. The faster it is resolved, the higher is the maximum value. So there has to be some certainty in terms of time, because moment a financial stress happens, there are a lot of these, all the creditors will pounce on the company to recover their money first. The creditors are going to pounce on them and say, give my money first. The income tax department will pounce on them and say, give my money first. GST is going to ask them the same. Bankers are going to ask them the same. The salaries are going to same. And moment employees come to know this, what they will do? They will leave the company. Adding fuel to the fire. It goes on spiral. And there's a problem. So they say, keep a time and try to resolve it within that. And it does not talk about any value. Even as good as 6,700 crores of default in Go Air was given the same time, as good as some of the companies which has just a default of 1 crore. Whether it is 1 crore or 6 and 700 crores, the time limit is same. It's a time bound process. Everybody has to be accountable for it. Which promotes entrepreneurship. That is, do not criminalize the acts. Do not criminalize, penalize the promoters, allow him an exit if things don't work. What happens if you do that? There is an availability of credit. This is something which we studied 7-8 years back when IBC came in, which is called as availability of credit. Once something is resolved and the best case comes out of it, the money is back to the bank. The bank can further give loan to somebody else. And the process of economic activity starts evolving again. It revolves, it goes back, somebody doesn't pay, again it comes back to the bank and it goes. So there is a money which comes back to the bank which is for disposal to some of these businessmen. The last one is balance the interest of stakeholders. I don't know how many of you have read the headlines of IBC. Each time an IBC is there on for any negative news is for this reason, that bankers take more money than what creditors take. You'll be surprised in Videocon case, what is the amount of haircut which they give. Haircut means, out of the loan what is available to them. 96% of haircut they give, which means for 100 rupees of loan which was given to Videocon, they could approve the maximum value which was available was 4 rupees. 96 rupees was written off in the books. Okay, so 4 rupees itself is maximum. There is nothing more than that. So if bankers only get 4 rupees, what will the creditors get? What will the salary guy get? he is only going to get 0. He is not going to waste money with all these. He is not even going to waste time also in all of these. He will just move on to the next one. But is that unfair? Yes, it probably is unfair. But is it the best case? Yes, it is the best case. Nothing more than this. Okay, so balance the interest of all the stakeholders, from creditors to bankers to all of them. This is the whole summary of IBC which I tried to put in. I will spend some time here. There are different processes which are available here. If anybody has any question, we can stay back in this slide for some time before I move to the next slide. The first one is called as CIRP, which is Corporate Insolvency Resolution Process. What happens in a CIRP is, if there is a company, when I say company, LLP is included. Other than company and LLP, nobody is included in IBC. And if the company has an obligation of payment, and if the obligation of payment has become debt, and the debt has become due, and the due has become default. I'll repeat, if there is an obligation, the obligation converts itself into a debt, the debt converts itself into a default. Becomes due and then the due becomes default. And if the value of such default is more than 1 crore rupees, the creditor can go to NCLT and then initiate a process called as Corporate Insolvency Resolution Process. Who can go? 3 types of people can go. The first one are the financial creditors. Who are the financial creditors? Bankers, NBFCs, these are all called as financial creditors. So they have excellent record of what loan they have given. They have an excellent record of all the signatures. So it is very easy for them to prove that you have taken more than 1 crore rupees loan, the loan was due, the due became defaulted. And the default day can be as more than 1 day. As of 1 day. So technically NCLT says that the default date, let's consider it as NPA date. So technically 91st day for an accountant, but for NCLT it is 1 day of due. At the moment it reaches 1 crore, there is a default, he can apply to NCLT and then they can admit the case. Come to the creditors. That is operational creditors. Who are operational creditors? Vendors, salary payment, all the government obligations, TDS, GST, income tax, municipality tax, whatever, corporation tax which we are supposed to be, all of them are OCs. They are given no preferential over the financial creditors. They are just like any other vendors in IBC. If they file a case against some of their vendors that they have not paid 1 crore rupees, the case can be admitted in for CIRP. I forgot to mention one case in financial creditor, even the home buyers. Home buyers are treated as financial creditors. That means if there are 10 people who can put together and they have been advanced to the developers and the amount is more than 1 crore rupees, it technically is 10% of the allottees it says, but anyway, home buyers are treated as financial creditors in IBC. Okay? The third case is voluntary. That is, if a company has defaulted and they cannot survive this business more long, they will go to NCLT, voluntarily themselves put an insolvency petition, say that they want to be declared, put through the process of CIRP. And who did this? GoAir did this. You not believe GoAir got its extraordinary resolution signed. Within 10 days it could file an application in NCLT Delhi bench, and then within 10 days the NCLT got an admission order. Now why this admission order comes is very interesting in a GoAir case. I'll tell you why. Moment when the case is admitted, whether it is under section 7 or whether it is section 9, 7 meaning financial creditor, operational creditor or self, 3 cases. Moment the case gets admitted, there is a moratorium which is declared. What's moratorium? That means no pending proceedings, no initiation of new cases. Nobody can initiate for that old obligation. That means if today, which is 9th of December 2024, a case gets admitted today, all the obligation as on 9th of December 2024 stands still, status quo. No creditor can come to the company's office and ask for money because it is under the process, moratorium. Don't ask me, moratorium is declared. If you ask me, can income tax department come? No. Can TDS department come? No, they can't. Can they attach? They can't attach. What if they are already attached? They have to remove the attachment. They have to remove the lien. They can't proceed. What if they have started the proceedings? They have to stall the proceedings. Everything gets for a standstill under moratorium. So in Go Air case, what happened? They had, because they are into the airline industry, they had all their airways, flights, the aircrafts bought under lease. So when aircrafts were bought under lease, and if you don't make the payment, they have to return back the aircrafts back to them. Moment this admission happened, standstill. Whatever aircrafts were given to Go Air, the Go Air will still run it. They can't ask the air flights back from them. So the Go Air decided to run the flights without making payments. Is it wrong? People have their own opinions, but they took shelter under IBC. They were running the flights but not making the payment because moratorium was declared. Okay? But only case under section 8, which is the vendors, I said you right, operational creditors. There is a small trick which is called as, if a vendor insists to make a payment, and which if it is more than 1 crore, and if the value is disputed, if there is a pre-existing dispute, the case will not be admitted. So all the cases in NCLT are fought on only one condition, that there was a pre-existing dispute. The dispute can be based on quality, the dispute can be on value, the dispute can be on anything. But there has to be a pre-existing dispute. Before you file a case, if there is a small email conversation stating that some reason that we are not agreeing with the value, or we are not agreeing with your price, or we are not agreeing with the quantity which is delivered, the dispute is there. The case will not be admitted. So in addition to obligation becoming debt, debt becoming due, due becoming default, there should not be any pre-existing dispute also, only for operational creditors. But for financial creditors and for voluntary application, these conditions is not required at all. In the section 7, which is filed by a banker or financial creditor, or in the section 10, which is filed by voluntarily, or sorry, in section 9, which is filed by an operational creditor, there is an argument and a counter argument. That means a banker files the insolvency petition against the company defends it saying that I don't have due, I am not supposed to pay, there was no agreement. Of course, these are all the stands which we will take. Interestingly, when the company files for voluntary insolvency, there is no opposition party at all here. The company says, I want to liquidate voluntarily. Whom should the counterparty be? There are no counterparties. So creditors don't even have a chance to go and argue the case there. They have to file an IA, but they will not even be heard. Once it is admitted, they will say, we'll hear it later. So in a Go Air case, the creditor, who is this lease company, they came running and filed a petition saying that it is a fraud application. They said, you don't even have a locus standi to fight the case now, because it is between the adjudicator, which is the NCLT bench, and the voluntary, that is the company. You don't have a locus standi in this case. Okay? So some of these companies can use it. So imagine, I said you about, in strike off I said you, default. Now come to this situation. If there is a default of more than 1 crore rupees and the company wants to resolve it and get the maximum value, go for CARP. Either by voluntary or the creditors or the financial creditors, any of them. Once the CARP is declared, what happens is, I said the moratorium is declared. There are a lot of things which happens. I don't want to specify each of them because they are all chapters by themselves. There is somebody like us who will get appointed, who are called as resolution professionals. They are initially called as interim resolution professionals, then they are later called as resolution professionals. Once a resolution professional is appointed, under law, within 270 days, he has to close this process of CIRP, 270. That is, if I start today, which is 9th of December 2024, the 270th day, the CIRP has to be completed. How it has to be completed? Two means. I'll just go forward. There are two means. One, either somebody comes and buys, or they go for withdrawal of the case, or either he repays the money, the promoter comes and funds the money, then the banker itself extends the loan. There has to be some means that the borrower and the payer, they both have to agree on some terms. Okay? Let's suppose that also does not happen. Let's suppose it's the case of Byju's. They have come to a deadlock where the company does not want to pay or have no money, and the receiver, that is the lender, wants his money. The 270th day is coming, 70th day is coming. What happens next? Natural course of failure of CIRP is liquidation. The natural course of a failure of CIRP is liquidation. So, there are a lot of research which is done. What happens? India is a company where concentration of shares are there. That is, we have family managed companies are too high in India, correct? So what they do, they don't want their company to be going into liquidation. They don't like it. So two things will happen. Either better themselves by proper payment, or go to CIRP. You miss the CIRP deadline, go to liquidation. Okay? That's how stringent it is. That is, they see their own company going into liquidation soon, which promoters don't like in India. So there is a behavioral pattern which this law also wants to correct. And in case somebody wants to withdraw the case, that is also allowed. Okay? So the second row is the failure of CIRP goes to liquidation. The third is called as voluntary liquidation. We will go this in length at some point later, but what is voluntary liquidation is, if you don't have a loan, or if you don't have a default rather, you go for a voluntary liquidation. That means you see a balance sheet, oh, there is an asset on the balance sheet, so you can't go for strike off. Okay, strike off is not allowed. Come to insolvency. You come to insolvency, oh, there is no, you see, is there a default? There is no default. So CIRP is not allowed. Oh, can we liquidate? You can't liquidate because the natural course of the failure of CIRP goes to liquidation. So you can't even do liquidation. So what else can you do? You go for voluntary liquidation. Which means there is no default, but there is an asset in the balance sheet. You want that asset to be distributed to the stakeholders. You go for voluntary liquidation. We'll go in length. I'm just giving the scenario so that you fit into where they actually, can go to. Then there is something called as pre-pack insolvency resolution process. What is a pre-pack? This came in during the COVID era. What is pre-pack? Pre-pack said that going to courts, hiring a lawyer, giving advertisement, and moment you give advertisement, the whole creditor community will know that this company is going into stress. There is a negative connotation which will be applied to this. There is a negative emotions which are running, and nobody wants to trade with a guy who is into near failures. All of these. So you have to avoid them. But you still will have to put through some process. So what say that? Okay, we'll do something called as pre-pack. What is pre-pack? That is, do not even inform the NCLT that you are forming. The creditor and the debtor, that is the corporate, the company, and the lender, both decide together, arrive at some formula. Either they will reduce their loan amount, or either they will increase the term. They will restructure it in some way. When the restructure is done, or they will do some write-off, all of these, then go to PPIRP. Then go to NCLT and say, we have already done all of these, give an approval. I mean, technically if you see, just a memorandum of understanding is also sufficient between them, because it's a contract. The lender and borrower themselves can enter into an MOU, or they can just do a contract arrangement. But contract arrangement is just between two parties, right? What if you have to bind too many people together? There are a lot of people who you want to bind together, and you want somebody to authorize it. So NCLT comes very handy. The bench comes very handy because you can put all the creditors put together. You can write a draft where any amount of restructuring can be done. The interest change, the collaterals can be changed. The number of time can be changed. You can do all of these restructuring and then put it into and then go to PPRP. Now that gets approval. That is, the lender, borrower and all the parties involved are bound by that because it is already approved by NCLT. That is called as pre-pack. And the next one is called as personal guarantors to the corporate debtor. In India, if you see, all the loans which are given by the banks ask the personal guarantee from the promoters. No banks will give loan without the promoters giving guarantee. So what they have done is to bring the personal guarantee to the corporate debtor also into IBC. So if a company does not pay an amount, the banks can file a case against the company. The bank can file a case also against the guarantor of such loan, who is the promoter. And many a times, it is not the promoter, it is the promoter's and promoter's wife, or promoter's husband, promoter's brother, who will generally sometimes be not even related to business, they are just their relatives. The banks have pulled even them also into IBC, and that becomes a real dispute. Moment you put a case against promoter's wife, let's suppose wife is not even involved, she doesn't even know what is happening in the business, she's very happy with her own life. But if you pull her into insolvency and say that you are going to be bankrupt, no promoter would like it. So there is a correction of the behaviors which is happening. So that will go to the last one, which is promoters. And this they can go against the company and also against the promoters. Not that if they go against the company, they can't go against the promoters, or if they go against the promoters, they can't go against the company. No. They are coexisting. They can go together with each of them. Rather, they can go against the company. Let's suppose the bank gave a loan of 75 crore. That went into CARP. And they could recover 50 crores. They can go against the promoter for the next 25 crores. Okay, I mean, while they resolve 50 crores here, they can go for the other 25 crores behind the promoters. I mean, this is theoretically I am saying. While what happens is technically, when in the practical situation, what happens is, when the negotiation happens, they ask to withdraw, they ask them to give a consent from the bankers that they will not proceed against the promoters. Of course, these are the conditions which they put while they are negotiating. But they can go. I mean, so these are the 5 cases, 5 different processes of IBC. Yeah.
What happens in LLP? What happens in LLP?
Between LLP and company, the law remains same.
But LLP is limited, no? Liability is limited, no? How can we go to promoters?
So even in company, it is limited. So if you go, bankers, when they provide loan, they ask the guarantee. So there is a separate agreement which is entered between a promoter and the banker for the guarantee. Now this guarantee is coexisting as much as what the loan is. When it came in Supreme Court, I don't remember the case very perfectly, the first argument which came was that once the CARP is entered into, and let's suppose you enter into some CARP and the value is declared. In my example which I gave, the bankers lent 75 crores. And the CARP went through and there is a buyer who came in who was ready to offer 50 crores and the bank also accepted and the bank took 50 crores. One way of argument which the promoters did in Supreme Court, I mean this went to Supreme Court, was that once you have entered, when the main when the main debt is only not there, when the main debt is itself not there, why are you going behind a guarantors debt. I mean, we don't exist actually on paper. Supreme Court said no. While they coexist, to the extent of 25 crores, which is the differential amount, they can of course proceed against the promoters. And not one promoter, they can go against all the promoters. Okay, and which they do. That is, what they call as, twisting of arms. That's how they come to terms. Or else sometimes promoters are very difficult to, negotiate. We have handled very, very difficult cases where they won't even allow us inside their premises, forget about going inside. The security will not even open the door. We have to stand outside, the bankers have to come, you have to take videographers, go there, you have to record, you have to take police protection to enter inside. And sometimes promoters are also very cranky to save their pound of flesh. Okay, so between CARP and liquidation, one more fundamental difference is going concern. In CARP, all the efforts are put to ensure that the company isn't going concern. But in liquidation, there is no necessity of such concept. Moment the word called liquidation comes, the company is already going to ICU. It has to die eventually. It is a near deathbed case. But in CARP, you have to try to take it under going concern. Okay. So, for example, there is a case in Vasan Eye Care. I don't know how many know. Vasan Eye was there. It went into IBC. So Vasan Eye was there in lot of places across India, in South India rather, not even India. And they had rental properties. They did not own all their hospitals. They were on a rental properties. Moment they went into IBC, all the landlords came in and said, vacate our premises. So the resolution professional went to NCLT and said, if you ask us to vacate the premises, technically you are reducing the value of the businesses. So they said there can be an agreement between the lessor and the lessee for rental payment. But the default which is there as on the start of CARP, which is the CARP commencement date, has to be filed separately. From the date the CARP is admitted, that amount will be paid by the IRP, but for those old defaults, you cannot insist us to pay. This is so strong that even the GST obligation as on the day of CARP you can't enforce. So CA has to take a separate GST registration. So there is a separate registration they take for the going concern within the CARP periods. So all the older obligations will stand still. I'll come to the Rainbow case, which is a very interesting case, which again went to Supreme Court in some time. And one more thing in real estate, because real estate one of the 30 or 35% contributor in IBC case in India. In real estate, the resolution is not on a company basis. The problem when company was, when we attach the meaning of company, right, which is a legal entity, sometimes the company has two projects. One is probably in Nungamakam, one is in Tambaram. The development which is happening in Tambaram probably went into problem. That went into problem, they were not able to acquire land, or they were not able to, build something. They went into some litigation. Because there was a problem in the site in Tambaram, technically you can also have an impact for a project which is happening in Nungamakam as well, correct? So when this entity concept, legal entity concept was introduced in IBC, the customer, that is the home buyers in Nungamakam feel cheated, because even their asset also went into CARP. While technically they were happy living, some of them had already been happy living there, just that their project handover takeover did not happen, or RERA approval was not given. Just because of these concepts, what happened? There were home buyers who already had moved in, occupied the property, their property was also attached in IBC. So they felt cheated, so they said, let's segregate the project. The project which is in CARP, so only for real estate it is project-wise CARP, not company-wise CARP. I don't know how many of you can see this. This is the whole process of CARP, which is see there is the right side, the default is more than 1 crore, the application to NCLT by FC, OC means financial creditor, operational creditor, CD means corporate debtor. It is admission. Once the admission happens, 3 things it will happen. 1, an IRP will be appointed. IRP means interim resolution professional. Second, all the board of directors powers are suspended. Okay, there is no more powers for board of directors. Third, the moratorium is declared. So board of directors only powers are suspended, not the responsibility. Next, the IRP will do a public announcement. He will do public announcement in a newspaper. Then so what is a newspaper? Newspaper is to calling for claims. That is, whosoever has any payment, claims, come and claim. So there are different forms. I don't want to go into forms because it is not necessary. It is only for insolvency professionals like us. They submit their claims. The claims are collated. So moment the claims are collated, you will come to know what is the obligation which the company has to pay. Total claims. And among the claims which come in, the financial creditor constitute a committee called as committee of creditors, unrelated, not related, the unrelated financial creditors constitute a committee of creditors. This constitution of COC, what we call committee, is the brain. It is called the wise brain of IBC. They are the ones who will approve or not approve a plan. Okay? Just imagine there is a committee. If there are no financial creditor, the first 18 operational creditors becomes the committee of creditors. We call it a COC. So what will the COC do? The COC's job is to call for the best plan, the resolution plans, whosoever wants to resolve the plan, and then approve the plan. They need not approve the higher value. They can approve whatever they want. They say, that's why I said they are the wise man. If somebody is offering more and they feel he has less experience, and there is a company B who wants to solve, who is providing less amount but he has more experience, they may perfectly choose company B. They need not even choose company A while resolving. Because it is their wisdom, wisdom of COC. Wisdom of COC cannot be questioned in IRP, neither by the NCLT bench. In Sivakumar, I think there was a case in NCLT Chennai bench. NCLT came up with a new word called as, we are always known for knowing this, called as wisdom of COC. The wisdom of COC is superior, nobody can question. The NCLT said the wisdom of judicial is better than the wisdom of COC. That was later struck down, saying, don't come up with new terms to confuse. The wisdom of COC is superior. If they want to liquidate, they can liquidate. You can't question it. Okay? Then further, there are again duties of resolution professionals, which are, if you can understand well and good, if you don't understand perfectly well and good. Now let's come to voluntary liquidation. I did not spend time on voluntary liquidation. Voluntary liquidation is again covered by IBC. Go back to the scenarios. Strike off, no asset, no liability, strike off. Loans more than asset, insolvency. Loans more than asset, no resolution, liquidation. Asset more than liability, voluntary liquidation. See the balance sheet. If the asset,
In one case, what happened was company was not formed. Company was formed, but the business that was not filed in the
strike off.
No, before that. So share capital money was not even introduced.
Strike off.
But when we applied for strike off, they are like, you have to file a balance sheet and P&L. So we filed a nil balance sheet and P&L. So they are like, you have to at least show 1 lakh and negative 1 lakh.
Yeah, so strike off, see in the case which you are saying, right, the strike off is allowed only when the ROC initiates. You are trying to initiate the strike off. So the condition for a strike off is no business for more than 2 years. This condition what you are saying is not for self, it is for ROC. Not putting the subscription money is a condition for ROC to move for a strike off, not for the self. That is why this doubt came in. Okay. So voluntary liquidation, asset more, no liability. Okay, or you have a liability, but the asset is so much that when you sell, when you make, you can pay back those liabilities. Okay. I've given you some of these briefs. There is a section 59. This is the mother section for all the voluntary liquidation cases. One, it is governed by a regulation called as Voluntary Liquidation Regulation 2017. The provisions of section 35 to 53 of chapter 3 also applies. Chapter 3, which is section 35 to 53, are for liquidation. So mutatis mutandis, same thing applies. What applies to liquidation also applies to voluntary liquidation. Okay. And all the personnel of the corporate debtor, which is the company and the LLPs, have to extend the support. Not only here, even in CIRP, I know some of the cases where the IRPs wanted the chartered accountants to give the documents, because the moment it goes, these promoters become cold, they won't provide the documents, they won't allow the access to the company and all of that. So IRP generally, when he writes to all the stakeholders, some of the stakeholders are all the government authorities, income tax, TDA, GST, PA, PSI, these are there. Second set will be bankers, all the loan, creditors will be there. He will write it to promoters, he will write it to some of the co-founders, investors. Additionally, he will also write it to the auditors. And in one of the case I remember, he wrote to the auditor stating, I do not have the audit report and the accounts book, give it. So the auditor wrote back, we have the accounts book, pay us our auditor fees. So he said, I cannot give you the auditor's fees because as on the day in which the CIRP starts, the obligation you have to file a claim. Auditor said, until you make my payment, I won't give it. Moment he declared so much, the proof of established, the IRP went to NCLT bench and said non-cooperation by the auditor. So then what happened? The auditor came in and said, I don't have accounts copy, I am not the one who is responsible for maintaining the accounts book. IRP said he has written a letter stating he has a tally backup. So NCLT said, you better cooperate. So they said, if you have a claim, good, go and accept it. In one more case, it's a Chennai based, I don't want to name those auditors. The auditor said, until you give me old auditors, I won't audit the the existing year's books. He said, if the old audit fees is pending, file a claim. On that basis, you can't say that current year's audit will not be done. Current year's audit fees, if you raise now, it becomes part of going concern cost, which IRP will pay. But the old audit fees, you have to file a claim. If there is money, I will pay you, or else it is vanished. Auditor said, we won't audit. So he said, give me NOC. The auditor said, until you pay the payment, I won't give you NOC. This fellow went to again NCLT and said, the auditor, who is Chennai based auditors, he said, they are neither auditing, neither giving NOC. So NCLT said, if you don't give resignation, we ourselves will appoint a new fellow. We have powers to appoint it. They appointed the new auditor. So as such, we all have written off a lot of audit fees in our books. So if such case comes, don't fight it. It is anyhow a written off case. Rather write off and cooperate. Okay. So section 19 is there. This is when IRP files, this is section, they go under section 19, which exactly says that all the personnel should cooperate with the IRPs. He is the officer of the court. Okay, this is where they generally file. So in case you have a case, be very mindful what you reply. If you reply something that I have a tally backup, give me my fees, and if you establish in the books, if you establish in email, 19.2 is what you will face eventually. Okay, but only thing in voluntary liquidation is, no promoters should think that, see, sometimes what happens when we draft the balance sheet, we all know, we are all CS, we know sometimes we want to reduce our obligation. I said you asset more than liability, go for voluntary liquidation. Don't try to write off the obligations and then go for voluntary liquidation, because that creditors does not know or he is not following up. Don't try to write off and then do all those accounting techniques and then go for voluntary liquidation. Because if there is a fraud, there is a penal clauses as well by bench, because it goes to the court, right? So they are going to counter question it. And there are cases where people have tried to write off the liability, reduce the liability, make the asset look big, go for voluntary liquidation. Suddenly they have been caught. Because some creditor will find out, they'll go to court and say, I mean, that's the fourth one I said, that adjudicator may impose penalty on any person who initiates voluntary with the intent to defraud. And the penalty can be as huge as 1 crore, from 1 lakh to 1 crore. Okay? So who can initiate voluntary liquidation? The voluntary liquidation can be initiated only by a company, no creditors. It is voluntary. Okay? But they have to give a declaration. Now when I say company, I also mean LLP. So if it is a company, it is the board of directors. If it is LLP, it is the designated partners. So majority of the directors in their board meeting should pass a resolution to voluntarily liquidate. But they have to give a declaration in affidavit. What are those declarations? One, that they have made the full inquiry into the affairs of the company and they have formed an opinion that the company has no debt and it will be able to pay the debts in full form. That means they are not saying don't have debt. They are saying you have debt, but the assets are so huge that they will be able to repay, or they have no debts. Either of these two conditions. And the company is not liquidated to defraud the creditors. These are the two conditions. Section 8 company can also go here. I said you RBI, those companies, those companies which were regulated by RBI, IRDAI could not go into strike off. They have to only use by voluntary liquidation. Okay, there are two documents which they have to place in the board meeting. One, the audited financial for the past 2 years and the provisional balance sheet, the statement of affairs up to the date of passing the resolution. These are the two other documents which has to be placed along with the declaration. Once the board meeting is done, of course the natural cause is to go for EGM, extraordinary general meeting for a company. And if it is an LLP, it is not EGM, but it is just approved by the directors, because there is no concept of EGM and board of directors. Everything there is only designated partners. So LLP excludes there. Now, once the EGM is declared, two conditions again. One, the company has creditors, the company has no creditors. If the company has creditors, within 7 days of passing the resolution, they have to take the approval from the creditors to the extent of 2/3 the value of creditors. To the extent of 2/3 the value of the creditors, creditor approval has to be taken that they are going for voluntary liquidation and they are okay with it. They have to consent for it. What happens if there are no creditors? Creditors' consent is not required. So this is a hygiene point you have to be very mindful before you go for voluntary liquidation. If you are going for a voluntary liquidation, and in that voluntary liquidation one of the creditor is TDS, income tax, GST, take it from writing, they won't give you consent. They won't give you consent. First thing, moment they come to know you are going for voluntary liquidation, is to send a show cause notice against him, that they want to assess against him. And moment you are in assessment circle, you are in a circus of going around, coming around. So the hygiene point is first clear of all those creditors, which is statutory dues. If it is just small vendors, it is easy to get, like you are supposed to pay salary, you are supposed to pay director remuneration, you are supposed to pay rent payment. These things are very easy to get than to statutory authorities. Now one day is very important now. What is the day? The day on which the EGM, the resolution in the EGM is passed. One, or if there are creditors, the day on which the approval by the creditors is granted. That day becomes crucial, and that what we call as voluntary liquidation commencement date. Voluntary liquidation commencement date. Why this becomes important is the voluntary liquidation has to be completed by 90 days if there are no creditors, and if there are creditors, it has to be completed by 270 days. That means if it starts now, by February 10th, the voluntary liquidation is over. You are already filing it with NCLT and you're washing your hands and the company gets closed. Theoretically I'm saying, There are a lot of other hindrances which you will get on the way, but that is how it is. So fast it can be. Within 90 days you can close. So we know some of those companies where there are assets, they want to book the long-term capital gain in the current year, all of these. They use this means, long-term capital gain, close the company. Some of the subsidiary companies' assets are simply sitting, close the company, liquidate and move it there. But can a defaulting company come here? No. A company which is in default cannot come here. A default company has to again go for only CRP, not here. So once the approval of creditors is given, the liquidator gets appointed. Who is a liquidator? Liquidator is an insolvency professional. He gets appointed. Within 7 days of passing the resolution, it has to be intimated to ROC. So in your master database, there is a column, there is a row called as active. That active changes into under liquidation. Okay, he has to file it within 7 days, both for LLP as well as for companies. Now, what's the impact of voluntary liquidation? The first impact of commencement of, not voluntary liquidation, what is the impact of commencement of voluntary liquidation? The first thing, that all the businesses cease to exist because it is going to ICU. No businesses, no going concern here. Only in CRP it is going concern. In voluntary liquidation it is winding down. Slowly close the businesses and come to standstill. Only that part of businesses which are required to close the business you can do. So you can't now start new operations, starting new businesses, amending the MOA. You can't open a new plant, buy a new, no, none of these can be done. It has to wind down. You have to slowly start selling the asset and then close. It is a very interesting case that in India, even in liquidation, there are petitions which are filed to run it in going concern. NCLT allows the company to be sold as a going concern even in liquidation. This is exactly against the principles, but it is allowed in India. So there are 2-3 definitions you have to remember. One, stakeholders. Who are stakeholders? Stakeholders are one of those beneficiaries of the sale proceeds. Some of these creditors can be stakeholders, debenture holders can be the stakeholders, bankers, all the obligations. Any obligations, liabilities are there, they are the stakeholders. Who are contributors? Contributors are those who have not paid their portion of share amount, share value. They are the contributors. So contributors and stakeholders. And who is an adjudicating authority? NCLT is the adjudicating authority here. Who can be the liquidator? The liquidator has to be an insolvency professional. If the insolvency professional can be an independent director of that company, that only then he will be appointed. That means there are 2-3 more conditions if you can go through. He can't even be a statutory director of a company. A statutory director of a company in the past 3 years can't be a liquidator. Not even statutory director. If he is a consultant and if the contributing is contributing more than 10% of his total revenue, then that consulting firm where he was a partner, even then he is also ineligible. So technically meaning, get an independent guy who has not had any business or pecuniary relation with the company. That's what it technically says. I'm not dwelling more into it because these are all for the insolvency professionals, not for general CA members. Now what happens to those who have got claims? Now again there are 4 people who are there, generally 2 to 3 people. One, he is a financial creditor. The financial creditor has to form B, he has to file his claim that I have a debt amount which I have to receive. The operational creditor has to file form C, the workman and employee has to file in form D, and then the other creditors will have to form F. So if you can see, it is B, C, D and F. You may ask, where is E? E is for, sometimes what happens, employees are too large in numbers. There are 300 employees. or sometimes there are 3,000 employees. All the 3,000, if they jump on the liquidator, liquidator will not be able to verify. So they will appoint a new guy called as authorized representative. So they all go to the authorized representative. Authorized representative go and will talk. Because if 3,000 people become the stakeholders, what will happen? I mean, they will not be able to take any decision. If the stakeholder meeting is called and 3,000 people come, how will a liquidator work? I mean, we are not able to work with 500 people in parliament. Where will we work with 3,000? Not possible. So some of the principles in claims are cost of proof. That is, whatever is the cost which is incurred while filing the claim has to be borne by the creditor. It will not be refunded. Whatever is the cost which is incurred to verify the claim, because if a creditor files a claim, the liquidator also has to check whether the claim is correct. And in case he incurs any cost, that cost will be reimbursed to him. And any claim which is given by any workman, financial creditor, operator has to be substantiated. For example, in the case government, let's suppose GST. GST cannot say there is let's suppose there is 10 crore rupees of due. Why? Where is the due from? Have you passed an assessment order? Assessment order becomes the base of filing their claim. Okay? What if it is in foreign currency? If it is in foreign currency, it will be multiplied by an exchange value, which is as per the regulation 25 of IBPI. I'm not going in detail, I'm moving fast there. And if there is mutual credit and debit, it can be set off, which is allowed to be set off. And all the claims have to be verified by the liquidator. The last one, that is the major job of a liquidator. That is, he verifies all the claim, whether it is right, wrong. He will sometimes ask for clarification, all of these. And then he cannot reject it, but he will not accept the claims. He will only accept to the extent of what is substantiated or what is available with him as a record. Based upon the claims which come in, he prepares a list called as a stakeholders list. So he prepares a stakeholders list with the amount which his claim is admitted, and if applicable, the extent to which the debts are due and secured. So he also marks a list which has secured, unsecured, what portion of the claim was rejected, what portion was accepted, all of these. And within 45 days of voluntary commencement date, I said you within 45 days, this is exactly halfway between the 90th day, he comes with a list of all the claims, which is list of stakeholders. So day 1, voluntary liquidation starts. Within 30th day, everybody have to give their claim. From there to within 15 days, that is 30 plus 15 days, he has to come with a list of stakeholders. Within that is 45 days. Okay? Okay. Well, because we are talking about claim, I will also run you through an important case called as a rainbow paper mill case, which is coming. Okay, I'll come to the rainbow paper mills. It's a very interesting case. So there are many reports which has to be prepared. The first report is called as preliminary report. This also has to be prepared within 45 days. And the contents of the preliminary report are there. I will probably proceed a little faster so that I can complete the other portion. If those who are interested can, of course, yeah.
See, the company is there, but assets is more than the liabilities, so they can move on the liquidation. But I am in the company's books, I am the creditor. I have more than 1 crore liability. Can I go to CAFG?
You are the creditor?
I am the creditor of the company, but the company has already assets is more than the liabilities. So they want to go for liquidation, on the liquidation. I am a creditor, I have more than 1 crore liability in the company. So can I go to CAFG?
Of course you should do that. That is how you meant the companies to pay your money. I mean, credit, I am presuming that it is a default.
Yeah.
But default, there's no default. The company has assets well above the liabilities, and if there's no default, there's no default.
No, some companies don't pay their vendors on time.
Okay.
So, yeah, in spite of having, many companies do that, right? So it is a way to twist their arms to pay it on time. So that is why when so pre-preparation for CIRP, when somebody comes for us, immediately what we say is we'll go through their email records, ensure that there is no event of default. I said, right? Are there any event of default? Slowly get the debtor's confirmation, because moment it is more than 3 years, the law of limitation comes in. So moment law of limitation comes in, the debt is there but it never exists at all. So slowly we reconfirm the debt back from them. So these are all the means which they do, so that once the debt is established now, it is there in the hand. One email is sufficient that we will pay 1 crore rupees after 5 days. Let them not pay. But if they confirm, they are caught. And so these are all the, if you go to some of the lawyers, advocates, they will teach you as to how to write email, then how to get that extract. This should not be debatable amount. The amount has to be 1 crore. I mean, this is again a status report. This has to be submitted within, if there are no creditors, within 90 days. This is almost near like a final report. Again, I am moving little forward. This is the final report. So final report is on the 90th day. This is what the liquidator submits to NCLT, which is the adjudicating authority, and the adjudicating authority, if he approves, he will give the order copy. The order copy has to be submitted to ROC, and the liquidation comes to an end. Yeah, this is a waterfall mechanism. When somebody talks about IBC, they should be knowing this portion of the thing very clearly. This is waterfall, that is who will be paid first by the amount which is having, not in voluntary. Voluntary, everybody has to be paid. In CIRP or in liquidation, whatever the first amount which kitty which is available is always first paid to the insolvency resolution professional. Once it is paid, the next whatever left out, pari passu between the two people. Who are those? The workmen dues for more than 24 months and the debt owed to a secured creditor in the event of secured creditor has relinquished the security in manner set out in 52. So secured creditor and the creditors for 2 years workmen compensation, these two guys take an equal share with whatever amount which is left. Second. Third, wages which if it is unpaid due, which is for more than 2 years. In the first one it was for up to 24 months, this is for more than 2 years, the third one. Fourth one is the financial debt owed to unsecured creditors. Fifth one is, again there are two people, any amount which is due to the central government and the state government, including the amount to be received on account of Consolidated Fund of India, and the second one is debt owed to the secured creditors for an amount unpaid for an enforcement. And the last one is whatever which is left, which is no case, and generally it will never be there, that will be for the remaining debts and the preferential. Now, why I showed you is to go back and talk about rainbow case. See the thing which is there in B and what is there in D. D talks about financial unsecured. B talks about secured creditors. This is where the problem came in. In B, if they had written secured financial creditor, what I say wouldn't have come. What happened is in Rainbow Paper Mill, in Gujarat, not in this GST era, in the GVAT era, GVAT. So they filed a claim. So in GVAT, there was a section which mentioned that any due amount is a charge created on the company. Okay, how do we create a charge in the Companies Act? We go and create a charge rate, we file as charge forms. But in GVAT it said, any amount which is pending means there is a charge created to the extent of the assets in the company. So they argued that on the day the due came in, to that extent I am already a secured creditor, I am sitting in B, give me my payment. So the argument was, how do you create a charge when you don't know where the charge is? You have it is just like saying, moment 1 rupee charge is there, the charge is created, but you don't even know. IRP, liquidator, nobody can ever know. Because in GVAT it said, all the amount which is pending to the government authorities is a charge which is created, and they created a charge. So they said we will fall in B because we are secured creditors. IRP said no, you fall in D. You fall as the government due. which is the operational creditor. So are they an operational creditor or are they a secured creditor? This was the matter of debate. Government wanted to call themselves as secured creditor. Now this problem went to Supreme Court. Everybody wanted them to be put into operational creditor. Unfortunately, Supreme Court held back, saying that no, they are the secured creditors. So they had to be given a clause with 53(2)(b). So moment they go to 53(2)(b), no, whatever asset is there, the whole asset charge they have got. That means if the asset value is 10 crore, they have created a charge of 10 crore. If the liability is 10 crore, or to the extent of liability. Now, why this is a problem is, in Companies Act, if you want to know a charge, you create a charge. They said, charge can be created just by writing it in Act. I mean, this is where the problem came in. I mean, how will you know where the charge is created? Correct. There are many municipalities, corporate acts which are there in India where this clause exists. Now, GST income tax, they have aligned it with IBC. What they have said is, if there is a difference between this and IBC, IBC will prevail over income tax, so that is settled off. But there is, Chennai Metropolitan, there is the Act, there will be Bangalore, BBMP, which is there in Bangalore, which has a separate act, where they said municipality dues will have a charge over the company. So they all come and sit in 53(2)(b). Moment they sit in 53(2)(b), no, when the charge is created, they will take all the asset. And what is there in liquidation value when all the asset is taken? There will be zero which will be left. So others will not get any value at all. That's why this came in as a problem. This is still not solved. Moment this Rainbow case, Supreme Court came in, income tax, GST, everybody started sending notice stating that they will also get their money, departments. But unfortunately, GST and income tax is now aligned with IBC. There are few older acts, which is the pre-IBC era acts, which have this problem. Eventually, we presume that it will be settled off, but as of now, this is not settled off. Okay, this is all about Rainbow. So if you have time, I will go through some of the case laws. Okay, I'll take 5 minutes. Now, when we file for voluntary liquidation, since this is the world startup era, I have got some cases for you. Let's take the first case. What happens to CIRP or voluntary liquidation where there is shareholders agreement which says that the consent is required to be obtained before moving to liquidation on CIRP? I'll show you an example. See, this is a reserved matter. If you do the startups, if any of you handles startups, they enter into shareholders agreement, correct? In the shareholders agreement, there will be one clause which is generally called as reserved matters. And if the reserved matters has a point which I have marked it in yellow, which is last 16th point, any dissolution or liquidation is a reserved matter, can the company go into CIRP or voluntary liquidation in such case? Just to go back and explain what is the reserved matter. In shareholders agreement, the reserved matters are drafted so that these matters are reserved and the permission of the investor has to be taken before they move these resolutions. They just want to ensure that they just don't pass any. So if you see some of these, any expenses of more than 15 crores is there, all these are there. These are the mechanisms to ensure that the companies don't pass any resolution which they want. I mean, they are trying to control them. So if there is a reserved matter, then even then can company go for voluntary liquidation or CIRP? See the points in yellow. I mean, these are a very standard process which lawyers write. So you have to be very careful in startup because some of the startups require voluntary liquidation, and if some of these clauses which are there, any dissolution or liquidation of companies are there in reserved matters, that means I have a company with me and I'm a client who is an SHA like these, he can't go into CIRP, he is not able to file voluntary liquidation because his investors want their consent and investors are not giving consent. It's a deadlock. Neither investors will put money, neither his product is successful, neither he is able to use voluntary liquidation or CIRP. It's a lock like this. So you have to be careful while you suggest some of your clients when you draft their SHA or SSA. So some of the companies also draft something called as defaulting events. So defaulting events are when the company's reputation is is damaged substantially. All these are defaulting events they write in SHA. So just to ensure that the promoters or the founders and co-founders are very mindful of what type of business they do. I'll show you an example of how it differs. See, this is one of the clause from SHA which I took. If a petition of insolvency, liquidation or winding up is filed against a company or any promoter, or if the company or any promoters are declared bankrupt or insolvent, or an acknowledgement is provided by the company or any of the promoters of its inability to pay its debt in accordance with applicable law, that is called as an event of default. I mean, event of default has a consequences in SHA, which say the board of directors resign and they will appoint a new board of directors. All of these conditions will be there in SHA. But if this is a clause like this, which effectively means if you file a voluntary liquidation, it's an event of default for them. That means they can take you out of board of directors. So you have to be very careful when somebody signs papers like these. So what is given in law is taken out by these investors. Be very careful. Fortunately or unfortunately, in the first clause, liquidation is filed against the company is there. The liquidation by the company is not there. So we went ahead with voluntary liquidation. Had the lawyers been careful by saying against or by the company, even there would have been a deadlock here. Okay, so this is. I'll go to the third one. I mean, can the initiation be passed by AGM instead of EGM? No, it can't be. If SHA mentions the priority of all amounts, this comes an interesting point. So in all the startups, what they do, in the event of liquidation, they have a point. Whatever amount which is left, if you go back to 53, see the last one, if any amount which is remaining to left, the last but one is preference shareholder, the last is equity. So it is, the last but one is preference, the last is equity, correct? So in startup, they have a very interesting point. This is how the liquidation preference will be, which means in the event of liquidation, if there is any amount which is left after paying everybody, the preference shareholders, who is generally the investors, because they come with a CCPS route or a CCD route, you have to not pay them the liquidation amount, you have to pay them the amount which they invested, or liquidation amount whichever is higher, they say. I mean, this is how the clause is. So technically meaning, in 53, if you go as per 53, what will happen? You will exactly pay what is their face value. Your commitment to pay to a preference shareholder is to the extent of face value, if SHA is not there. But moment when SHA comes in, and if they have a clause, you will have to reimburse them to the extent of what they invested. This is what it is. When I give it to the SIRC, probably you can read it in count. This is how it is. So if you are talking for a founder or for an investor, ensure that this point is there, because in the event of liquidation, or else you will not get it at FMV, you will get it at 10 rupees, which is as face value. You may invest it at 3,000 rupees per share, but while you get back, you will get it at 10 rupees per value, even though amount is there in liquidation. Okay, so these two clauses is what I thought. Some of the case laws are there, but I'll be indulging in the next speaker's time. So these are some of the snapshots which can be there. Thank you for the patience. Yeah. Yes, sir.
I have just one question. I need to understand the status of a liquidated company.
1 minute.
I would like to understand the status of a liquidated company. Okay, it's a voluntary liquidation that the company underwent. I'll basically give you some broad figures. It had negative reserves that were funded by the loan from director, and the director had foregone the loan. The company got liquidated. But I would like to understand the status of this company in the eyes of Income Tax Act, where any loan foregone is treated as an income in the hands of the company, and the company is susceptible to tax, right? So I would like to understand how the balancing between the different statutes is made.
Yes. So both in CARP and in voluntary liquidation, when the loan gets written off, there is no other means other than to show that in the books as revenue. So all the written off liability from the balance sheet. So I have a company where I wrote off ECB loans. It was given by ECB from a Japanese counterpart. I had to write it down. Moment I write it down, I had to offer it in revenue and P&L. In case I have, because in the example which you are giving, I am presuming that even in income tax, it will have brought forward losses.
Lower than
Yeah, it will. I mean, because when there is negative results, I am eventually presuming that it will also have a losses. If there is a brought forward loss, and if I am offering that income, and if they are able to set off, they are safe. But even then, the MAT provision was kicking in. Correct? In the new scheme of thing, MAT is not applicable if you take the new scheme. So this is a happy news from 2024. But before 2024, we were all sad because the moment I write off, it will go hit my P&L, and then there is suddenly a new huge income which pops in, and if they don't have to the extent of losses, then they had to offer the tax. But imagine a case. Some of the companies on the other side, sir, I mean, for example, who have invested, they would also take it as a write-off and then reduce it from their books as investment written off, as an expense in their books. So there was a case with us which we did, wherein there was losses like this, but a small amount of asset was there. So what happened was, he had a capital gain, so moment when the share capital went down, so when it was written off, technically he had a gain and then write off from his books. So gain and loss he had to set off. He used it as a means to tax save. So if he can save, that's a positive side. But if the revenue is more than the losses, of course he has to pay tax. There is no other means.
the company has closed its bank account also.
So they have given a declaration that if there is any obligation, they will pay from their personal pockets. One minute.
The previous slide, where you have mentioned about the voluntary liquidation, if there is any agreement with the investor and the company, is it like a dead lock? I just wanted to understand when the voluntary liquidation process is being mentioned in the statute, and this is like more of like an internal agreement. How can it override a statutory provision? How it works in the context areas?
It's I mean, this is a very interesting case. I don't have a precedence to answer in this point, ma'am, because I have searched all the available cases which is there. Somehow this has not come up in any of the NCLT benches for understanding. But we presume that when the investor and the promoter signed, that is also an obligation which they have to decide. So that's also an obligation for them to pay back, right?
More like an internal agreement, right? And it is when you compare it with the statutory provision.
Correct. So when we took an opinion, the opinion was that we are not violating any law because we are only saying the preference value has to be returned. We never said how much it has to be returned. So in 53, it only says the preference shareholders come last but one. It never says what value they come in. So what value they come is what is agreed between both of them, we decided. I mean, that was opinion as well. It only says the shareholders come last but one, but what value it never said.
Not in this one. The agreement between the investors and the startup company, when there is
Yeah, so-
reserved matter.
Correct. So this reserved matter is different. This is
Reserved
different.
matter you highlighted one point, right? The last one.
This one? This one?
Yes, the 16th point.
Yeah, so I mean, there the problem was, while this act may give you the permission, see what happens in reserved matter is, in case you are passing these resolutions in a board meeting, any of the matters which are there in reserved matter, it says you have to take a prior consent to a board meeting. So in that context, what will happen is, it is not disagreement. It is not following the respective act itself. So technically meaning the board meeting only has not been held. So ab initio, that means it is not approved by the directors only. That is how it will fall into a problem. Okay. Thank you for the patient here.
Is a little easier after hearing Pramod for the last hour and a half, because I am not covering such a technical topic, or rather there's nothing too technical that I am wanting to cover here. What I intend to do over the next hour at most, or probably a few minutes more than that depending on questions, etc., is what's this whole concept of GCCs. And we keep hearing GCCs now. You know, if you see anything, any newspapers, anything you take out, India's GCC boom, GCC is expected to become 105 billion by 2030. We're going to have another 300 companies coming in the next 1-2 years. What GCCs are, what do they do, what are the issues, what tax aspects are there, what regulatory aspects are there, very briefly, and therefore what opportunities does that create for all of us, either in practice or in employment or anything that we want to do as chartered accountants. That's really where I will leave the presentation at. And a lot of what I'm going to share today, like I said, not too technical but more based on practice. I come from a city which has the highest number of GCCs in India for sure, probably in some parts of the world as well. And over the last 20 odd years that I've been in practice, the number of GCCs in Bangalore that I've worked with, I'll just share some of those experiences. So what are GCCs? You call them GCCs, GICs, captive centers, you can call them what you want. They're essentially offshore centers which are established by multinationals to provide various services. So all of these are only into services. One way or the other, they'll be providing services, and they are called captive. Some of them call GCCs as global captive centers, global capability centers, global in-house centers. You can call them by what name you want. They render services to group companies. They don't offer services to third parties by definition. They operate only as an internal organization. So you could in-house, you could put all of your IT services together, you can put all your R&D services together, customer support services together. These are what are customer facing. But I work with some of the GCCs in Bangalore which do very routine work for the whole globe, for the MNCs. I work with a large UK multinational company which is present in about 130-140 countries into retail, FMCG, etc. They have a center in Bangalore which only maintains their entire mail server, mail networks, etc. So globally, wherever an employee joins, the email address is created in Bangalore, the help desk is in Bangalore, the people who take backups of email rules, maintaining the mail server, all of that is sitting in Bangalore. You have a large center right here in Chennai of one of the largest, probably in the top 20 US corporations, which has a tax center here, which does all the advanced tax computation, income tax returns, tax provision workings, income tax entries for all their entities in North America. And they do about 200-300 entities here. I'm working with CPA firms in Bangalore which have set up their back offices, which have set up their GCCs. One particular CPA firm which has ramped up from a 50-member team to a 350-member team in 18 months. So they do audit, they do tax, and they do their advisory work sitting here in Bangalore. Again, mostly housed with chartered accountants who are encouraged to do their CPA and get qualified as CPAs, and they'll be able to do the work. All of this initially started early 2000s, Bangalore being the biggest beneficiary, more for a cost arbitrage. So what started happening was Infosys of the world, Wipros of the world started setting up IT offshoring centers for clients. Then clients realized that this is a scalable model and why should I be working with a third party, and therefore I'll in-house some of these people and set up my own center. So the big famous ones are HSBC, Standard Chartered, Citibank. All of them started working with third-party service providers for offshoring a lot of their banking work. Credit card, payment follow-up, accounting entries, credit rating, insurance claims, all of that. Then they started saying we can have our own center in India which will be working for us. So what primarily started as a cost driver today has actually turned into a industry which is standing because of capacity and capability, not really cost, not just cost. The center that Deloitte has, for example, in Hyderabad, or KPMG has in Bangalore, tens of thousands of people doing audit accounting work, sitting out of here. Today, where are we? This is just government incentives. I'll skip this. We all know SEZs, STPs, which are not there anymore, but then they were the ones which kick-started. Karnataka has just come out with the first GCC policy, which has a goal of 500 GCCs by 2029 and also 350,000 jobs. They have announced some incentives. Tamil Nadu, for example, has a policy where they're paying some portion of the senior people's salary for 3 months and things like that. UP has come out with a GCC policy. Like I said, they have progressed over a period of time. If you see, the first set of GCCs were all business process outsourcing, really low-end work done by third parties in most cases, then smaller companies or larger companies with smaller setups in India, and then scaling that up. Then came the next one where you actually progressed into an in-house center. So you were working with third parties first, the first 5-7 years, and then you started in-housing them. Therefore, BPO became GICs from third parties to in-house, and then today we moved to GCCs because of capability that's there. This is something I covered. First, we started with cost arbitrage. There was a lower operational cost. One of the CPA firms was, incidentally, I was discussing with their global operations head, who would come here for the initial setup, evaluation, etc. The number of CPAs who are coming out and qualifying in US is on a steady decline. It's at the lowest ever. So they are not getting good CPAs, they are not getting CPAs at all in the US. Not many people are going into that stream, not many people are getting qualified as CPAs. There's also a large portion of CPAs who are wanting to work from different locations. Post-COVID, the CPA firms are finding it difficult for people to come in and work in the home location. So their thinking is, if my own people in US are not working here, then if I'm sending the data out, if I'm working with somebody remotely, why shouldn't I do it with somebody in Chennai or Bangalore? Because the cost arbitrage is going to be huge. And let me tell you this, when he told me the numbers, I was startled myself, because the starting pay for CPAs when they start in US is anywhere between $50,000-$60,000 and upwards, nothing lower than that. But they are hiring good, bright chartered accountants at 10-12 lakh rupees to start with. They write their CPA, most of them finish in the first sitting, see the difference in the cost. Whereas $60,000-$70,000 to whereas $15,000-$20,000 as a fully loaded cost that for operating in India. A lot of the non-Big Four chartered accountant firms in the US and UK are looking at India for this. So that's where it's not cost anymore. We moved to skill, where today we have a lot more qualified people. There are enough and more people who are qualified to do UK VAT and US tax here. Just look up LinkedIn, you will know the number of people who today worked for 5-10 years on US taxation, sitting right here in India. Then we move today, and this is still evolving, and I think this is where we'll finally get to, is the technology arbitrage. We've always had time on our side. One of the biggest reasons why India has been really big on this, and why not some portions of Europe, because Bratislava, Croatia, and there are many other countries which are trying to do GCCs, but they are not able to do much because of the time difference with US. India has a very sweet spot of 8 to 10 hours time difference depending on which coast that you are. Therefore, the US closes, that's when India is working. By the time India finishes work, US is starting. Which advantage even Philippines doesn't have today. A lot of the centers that we are talking to, a lot of the companies which have centers in Bangalore also have it in Philippines or some other places. But while manufacturing could be moving to other places including China, when it comes to this, one because of skill, the other because of timing, we will still have a benefit, and that will get added with a technology thing. because a lot of the R&D work that's happening, a particular client which is into medical imaging and they wanted design engineers for certain image analysis, image identification and things like that. And the person actually said that he is getting more qualified engineers with that kind of experience in Bangalore than even in parts of US. So therefore, cost is no longer the only reason, and some of these people are today demanding the salaries that you would get in US in dollars sitting in Bangalore, because it's become the skill and the technology also. It's no longer only about cost. There's a huge opportunity there. This is based on a 2024 March report, so therefore we are about 8-10 months behind. This report will be updated only next year. There are currently 1600 GCCs and it's expected to go up to 1900. The market size for GCCs has reached $60 billion from 19.6 in 14-15, that's in 10 years we've tripled. And more than doubled to 46 in 22-23, and therefore that's the growth that we are looking at. Right now, 18, 19 and 23, 24, the job creation was about 600,000. The amount of, for you to get a sense, I've lived all my life in Bangalore. I've seen it grow from what it used to be in the 90s to what it is today. The amount of round-the-clock working that you see in Bangalore, the number of cabs that go around at any time of the day, because there are centers which are working at UK time, centers which are working at Latin America time, centers which are working at New York time, and so on. There are centers, so for example, the Karnataka government has relaxed holidays for public holidays where they can actually work on our holidays but remain closed on July 4th, for example. Just a specific relaxation given because some of these are really critical services. Some of the centers that I know operate on what's called follow the sun. Follow the sun is wherever the sun is up, the center there is working, so that there's 24 hours. So they can today do that with about 3 centers. So if you want to call at this time, India is closed at 6:30, so there's somebody working in Europe. If you want to call in the midnight, it's actually a center in the US because they are working. And our morning is midnight in the US, we are working. So wherever the sun is up, wherever it is between 9 AM to 6 PM, that center is working. So a lot of these is what is creating a huge opportunity for GCCs which are there. Bangalore, like I said, has the lion's share. We have 30% of the GCCs in India. The next highest is Hyderabad with 19%. Delhi, Bombay, Pune, Chennai is at 9% and all other cities at 5%. I'm seeing a lot of interest in tier 2 cities, both in Karnataka and Tamil Nadu. This CPA firm that I'm working with, one of the CPA firms that I'm working with has 120 people in Coimbatore. And they're actually having it with a third party, and they have now we've helped them set up an office, take a GST registration, etc. and move into their own office. They've onboarded these 120 people effective Jan 1 from the third party service provider. Places like Coimbatore, in Karnataka, there are places like Shimoga, Hassan, etc. which are providing a lot of people who are qualified, basic qualification of BCom, etc. for accounting entries, accounting back office, that's there. This creates a huge opportunity, and I'll come to what that creates for us outside of what we can do in pure compliance, setting up, audit, etc. Why outsourcing? What is it that US companies look for? Firstly, better use of internal resources, access to skills that are unavailable locally, the point I made, which is really something that's got developed in the last, I would say about 10 years or so, not before that. Improved business for customer focus, lower operational cost, I don't need to explain some of these, and accelerated business processes is again because you're not spreading it thin. If there are certain processes which are being done globally in one place, then you're not having people to get trained again and again, because the person who's doing it here is doing it probably 10 times more than what he would have done if he was handling one country. There is a US multinational which has its entire vendor management and negotiation center in Bangalore. So the Bangalore team speaks to whichever vendor, compares the rate, sends it to US by the time they start in the morning to say, these are the 4 vendors we have compared, these are the rates, these are the terms. All they do is get 4 quotes. The quotes are taken by the teams wherever globally. So somebody wants to buy something in Australia, they've taken 3 quotes, they just send it to the team in Bangalore. The team in Bangalore tabularizes it, analyzes all the codes, does a comparative to rank it to say this is possibly better, sends it back by the time they start the day. That team then says, okay, this vendor is the vendor that I want to negotiate hard with. After that, vendor onboarding, taking documents, tax registrations, all of it is done by the team in Bangalore. So the entire vendor management process is there. Now imagine the amount of acceleration in business processes or how much improvement can be done if for globally you're doing it in one place. Rather than having 10 purchase managers, 10 vendor management teams in 10 different jurisdictions that are operating. Again, that's what provides a competitive edge in the market. Where are the sectors which are today attracting GCC? You're not able to see some of this, sorry. Software engineering, media entertainment. The last one is banking, financial services and insurance. Old days when we started off first, medical transcription, dictation, these kind of things were high, but that's all low end today. But today we are actually at significantly higher end of the value proposition. Again, key facts, some of this based on what is publicly available at this point. 300,000 jobs are being outsourced by various US companies to India and China. Every time Indian US companies are under pressure and want to cut cost, there's an opportunity for us. And today, while we are reading about tariffs that Trump is wanting to impose to get manufacturing back to US, kickstart the US economy. My personal view, China could be hit, but our services exports, which the significant portion, can't be replaced overnight. A lot of this can't be done just like that. A lot of the banks today depend on people in India. A lot of the insurance companies, healthcare companies, there are hospitals whose imagings are being done in India. There are people who can't today immediately shift out, and then you can't have a situation. I think this is something that will continue. On an average, 30% of the overhead cost is reduced. This is only overheads. 80% of European and US outsourcing firm ranked India as their #1 outsourcing destination. Tax benefits, we no longer have tax holidays that were there for STPI, SEZs, like I said, but 25% is as low as it gets even today with transfer pricing. We've helped a lot of companies, I will cover that in greater detail later, but a lot of GCCs move into a LLP model where the LLP pays tax once, and when you repatriate the profit back to US, there's no further taxation in India. So therefore, LLPs offer a good tax rate. There's no GST on exports. Therefore, and the 18% is claimed as a refund. And while there are practices and there are practices, but I can tell you this with absolutely no other ways to manage the system. GST refunds are coming through. It may take about 3 months, it may take about 6 months. They may deny a 10% claim, they may refuse 10% of some cost, and you may have to appeal, you may choose not to appeal, but GST refunds are coming. Therefore, today when you are speaking to clients, when you are speaking to companies which are wanting to outsource to India, the 18% cost saving is a huge one. Because if you take rent, you and I take rent, if we don't get credit, or if credit is not sufficient, or if you are in sectors where credit is not useful to a GCC, 18% comes back as refund. So a lot of the cost is actually very, very efficient and lower in India. There is a good tax treaty network that we have. So companies which are today working with 30, 40 different setups. So a large corporate has a setup here which has as a client 40 other group companies. So in different countries. I've just done an analysis. It could just be lucky that it's all 40, but all of them we have a treaty. So therefore there's no tax leakage or withholding, double taxation, none of those issues. So therefore, even if there's a service element, to say that it does not make available or there's no requirement to withhold because of a treaty, there are no leakages. Because today if you see, countries like Singapore and US, there's no treaty. UAE and US, there's no treaty. And then there could be a withholding of 30% in some of those cases on pure services. But that's not the case today. We have with most large corporates where we will have a transaction. Low cost labor as compared to other countries, I have explained this. The other big difference, subject of course to all the politics that happens around language, is today this whole session is happening in English. That's our biggest advantage. We both go back home, we don't speak English, we may not even speak the same language, but for us, our laws, our forms, the way we conduct business, our regular work is all in English, makes a huge difference for a lot of this work to be coming here. Ease of access to technology, again, one of the things that's the least spoken of late is how cheap data is in India. Data is really, really cheap. All of you who have traveled and used roaming or seen data rates in other countries will know how much we pay for data. Today, the reason that internet is as easily available to everybody is because of that. Therefore, even if companies have to provide work from home and take a huge cost on bandwidth, etc., it's not as expensive as it would be in other countries. There is undoubtedly a ease to access of technology in the country, which is really fueling and helping a lot of these things. Labor laws is a place where we could do a lot better. Hopefully the new labor code that is coming and that's been in the works for long should make this even better. But having said that, in most of the large states where GCCs are today operating, you take Telangana, Tamil Nadu, Karnataka, Maharashtra, Gurgaon, which is Haryana, or even Uttar Pradesh for Noida, all of these places have a good relaxation for a lot of these GCCs, including on timing, working hours, because a lot of our labor laws have strict timings on the hours of operation, but that's been relaxed for a lot of these GCCs. Like I said a while back, Karnataka labor laws are really relaxed for a lot of the GCCs to work round the clock, because if you just see our pure labor law factories at any of the other things that have been there, working for ladies, the amount of time, people who are to be there, what is to be available, a lot of it is relaxed because a lot of these GCCs today employ significant ladies, and in Bangalore a lot of them work at really odd hours, and of course safety is never compromised, but the law is not as stringent and as inflexible as it is for other sectors. But I think there is some amount of scope, and there is definitely an area for improvement here. Again, another thing that I hear often when I speak to companies which are wanting to set up centers in India, which some of us take for granted, is the political stability in our country. Yes, the parties always fight. There are two principal opposition parties which have the thing, the fight goes on, but our transfer of power is always peaceful. There are no issues when it comes to political instability or military coups, etc. Therefore, a lot of the Americans and other multinationals which are looking at India, when they do a risk evaluation on political stability, we score very high. And these become extremely important factors when they are moving and setting up in India. What are the common business models that are there? And here in the second part is where I'd want to spend some time, and there's a good opportunity for some of us who have an entrepreneurial streak here in this room. One is a lot of the overseas companies straight away go for a direct subsidiary setup. I've done a comparison between company and LLP, I'll come to that in a while. This is a pure plain vanilla model where the company just sets up a subsidiary in India, hires people, runs the business like a subsidiary. It's a dedicated development center. The processes they select will get transitioned to India. There are processes which they keep evaluating, and newer processes keeps coming. One of the UK majors had moved 15 processes at one point of time, and they were always identifying more, and their whole idea was to move 100 processes in the next 5 years that they've set up here. So these could be IT processes, finance processes, operational things, HR. There are companies whose entire HR work of screening of candidates, screening of CVs, setting up interviews, scheduling interviews happen in Bangalore. So there is a job description and a job role. There are 20 CVs that come. They have to be screened on a particular parameter, X number of years of experience, qualification being this. They screen all that, 10 are left, set up interviews. There's a calendar given, people in Bangalore make the calls, set up the interviews, ask them to come to office, and the whole process is done here. So that way they keep moving different processes. The overseas company here is only involved in supervising the service delivery of the captive unit. Everything else is by India. Most of these people have India sorry, delivery heads. This is generally adopted when they are wanting to move significant portions and important activities, or it is a long term. There are banks, insurance companies, even CPA firms where I have seen the agreement where they have with their client, which will say that no data of their client can be shared with anybody other than their affiliates, which really means there has to be a subsidiary in India, because they cannot be sharing it to a third party. So in some of these cases, again, depending on what works for them, they set up a separate entity. The cost would definitely be lower because they are running everything. There's no margin for any third party to be doing. And the tax cost tends to be lower because you do a transpricing markup, and then today safe harbor rules are available anywhere between 17 to 20%. Cost plus works, is safe. Again, internal support functions, software maintenance, customer supports, these are the kind of things this is suited well for, because those also need a lot of training for the people on the company processes. The second one is a very interesting model, and this is something that I've been seeing a lot, and I know chartered accountant firms which are doing this. There's a large firm in Delhi which is doing this. There are firms in Bangalore which are doing this, which is really a bot model. You build, you operate the center, and then you transfer it. So you actually go meet a US multinational to say that you will offshore all of their tax work, for example, or their accounting, etc., but not for the full period of time, because they have to get the benefits. They don't know India, they don't know if this will work. Therefore, you do it for a 3-year period, 5-year period. So you tell them you will build the center, you will operate it. No pain of setting up in India, no pain of compliance in India, doing business in India, whether easy or not, filing forms in India, OTPs, DIN, nothing on their head. You run the center, you set it up to say that I'll scale it up to 100 people, delivery is happening, you're seeing a cost benefit. At the end of 3rd year, I will transfer these 100 people to a subsidiary that is set up by you, you take it over and move on. And the companies which run this get a fee at the end of the 3rd year or the 5th year to say that there's an exit fee for having run this setup for 10, 15, 3 or 5 years. So very successful model. Initially, a lot of the IT companies use this to set up their centers. This was not so much for only what we are talking, which is finance processes and GCCs and captive centers, but even for software development centers. There are companies in Bangalore which set up similar things for aircraft design, engine design, CAD, CAM, etc., where the US companies were not sure if actually it could be done in India. So you try it for 3-5 years, it works, then you transfer it out. There are enough and more publicly available information on this. There are insurance companies which have in-house their center from Infosys. The fees ranging between tens of millions of dollars to hundreds of millions of dollars, depending on how many people they've run for how long and what kind of capacity that they've built. So, like I put here, SAP, AG, Oracle have bought out development teams from outsourced development partners. Early 2007, there was a company which took over 325 engineers from Aztec Software in Bangalore and set up a captive center. This is a model that's been in place. I think there's a huge opportunity here for practicing chartered accountants to actually look at opportunities either with clients who are outside India or with chartered accountant firms, CPA firms, law firms outside India. Even lawyers are doing this to say that there are things that can be done in India and I will do this for 2 or 3 years as a service provider for a fee. If it works and you see the benefits, these are the very same people who will continue and transfer them as your employees, set up a subsidiary for you and move them into that under your ownership, and you take them over and run it. Therefore, if I built a 50-member team and you think it's making sense, you scale up the 50 to 500, and that 50 to 500 cost is lower because there's no my margin is not there in that. But there's an exit fee. There are processes which today we are looking at and we are helping clients by a pure simple outsourcing. There's no reason why that can't be done for companies outside India, for that group to say that we will set up a center like this for you, which can handle either your payment processing, expense claims. reimbursement claims, salary processing, and things like that, which is a huge opportunity. There are quite a few actually. I dropped out some of them. Infosys has done a lot of what. There's a company called Nest Technologies, and if you do have time, just look up Nest Technologies, which was later taken over by Oracle, NESS Technologies. They were only into this. So they would have a client who will come, they will say, I'll set this up and I'll hand it over to you after 3 years or 5 years. And they all had an exit fee at the end.
Investment by the existing company or
Sorry?
the setup cost will be borne by the BOTs or they will...
It will be borne by the BOT. So what will happen is, there's an Indian company which will say, I'll run this center for you at say 20 lakh rupees a month with 50 people delivering this much work. So the cost, the margins, everything is theirs. To say that I'll run this 3 years at a service fee, at the end of 3 years I'll transfer the business to you at a particular fee. And then after that they continue it under their ownership. Therefore, until the time you are building and operating, you are getting a service fee. For transfer, you are getting a transfer fee. This is one slide which I thought I will just cover what are the things that we can do as advisors today. Whether you're practicing, you're in a company which is wanting to set up a GCC here, etc. We can play a role right from conceptualization until the entire thing, including operations and compliance after that. The form of business, whether it should be a LLP, it should actually be a branch. There were times when companies started with a branch office and then converted because branch is easier to close. Yes, there may be a higher tax, but that higher tax has also got narrowed after the last budget. So therefore, do you do a branch office, do you do a LLP, do you do a private limited company? How do you do the capitalization of the company? Because you can capitalize it higher, because one of the significant things I've seen, if you're doing a simple process outsourcing, the capital outlay is not too high because it's just a set of laptops. Most of even the servers, the softwares, etc. today is available as a software as a service for a license fee, etc. So there's no significant investment. Lease deposit is a big investment. Therefore, do you capitalize it as equity capital, bring it in FDI, do you fund it using debt, do you take debt in India, how do you service that, what do you do, what should be your billing, what should be the modes of funding. So that's second part. Thereafter again, the holding structure. When you are repatriating money, should it be through US, should there be an intermediary holding company? If you are having a multiple service recipients, you are servicing 20, 30 group companies, which should act as a service company, because a lot of the times there's also inefficiency built if India is doing, and then you bill based on headcount, for example, and you're billing to 20, 30 companies. There could be small companies, small billing, etc. So a lot of the times these larger corporates also create entities which pool in this service. There'll be a single entity which will get all the services from India and they will do a cross charge to others. Those are structures that we've seen which can be put in place. There's a play of GST, there's a play of transfer pricing there, and also of documentation that you need to maintain, related party transaction disclosure, multiple other things that can be considered there. Wholly owned subsidiary, LLP, like I said, LLP and company, I have done a comparison, and that's a very interesting take. I'll take you through that, because LLPs offer a clear tax benefit when it comes to setting up GCCs for US companies in particular. So if you set up a private limited company and the private limited company say has 100 rupees of profit, you pay 25 rupees tax, the 75 that's distributed suffers a dividend tax of 15%. So therefore you end up with almost close to 40% tax effectively. The same operation, set it up as a LLP, the LLP has a 100 rupee profit, pays slightly higher tax than 25 because LLP tax rate is 30 plus surcharge and cess, so 32-33%. You distribute the profits like any partner drawings that you do in a general partnership. The US company takes it out, there's no further tax in India. So you actually save a good 6 to 7% if you do a LLP versus a private limited company. We've helped quite a few companies set it up as a LLP. These distributions can be done quarterly. Most banks know what needs to be done. Most chartered accountants are today aware of what needs to be disclosed in a 15 CSCB declaration as to what has to be withheld because it is share of profit that is being distributed. And there's also a very important US angle to this. In US, you have the concept of disregarding entities and checking the box. So if the Indian entity is disregarded for US tax purposes, I'm oversimplifying it, the US will actually treat India as a branch. So whatever are the Indian things gets consolidated at US, and a lot of the India taxes enter the foreign tax credit pool of the US company. Like I said again, and at the risk of oversimplifying, there's a huge tax efficiency by using the US structures also to achieve here. So we've seen companies which have outsourced work to India, and the margin or the tax in India has never been a cost, because you're almost able to take out most of it using foreign tax credit. Even if there's a cost, it's a very minuscule cost, not really equivalent to doing a profit and paying profit tax in India and then suffering that in the US. Now, branch office, etc. used to be earlier. Liaison office cannot engage in revenue generating activities from a RBI perspective, so that rules out itself. But there are companies which have set up liaison office only to do certain administrative activities. Branch offices are possible, project office again for specific purposes. Corporate law compliances, yes, there are significant compliances here, but again, I see a huge play for us here. These are very simple operations. I'm working with GCCs, including outsourcing their finance. It's not as complex as anything else that you will see. And I don't need to say more than these two sentences because each of you will understand what I'm talking. Because it's a GCC and captive, is one invoice a month. The invoice is cost plus. 70% of their cost is two line items, rent and salary. You don't have recurring cost, you don't have a manufacturing P&L. It's simple books of accounts, not really too complex, but it does add a layer of complexity when somebody in the US is sitting and viewing it. Same thing when it comes to company law compliances, which is where we've chosen LLPs again, because if you do a company for board meetings, audit, etc., LLPs, none of those come in again. But as a practicing CA today, we will be able to offer a full, complete suite of services to somebody who's setting up a GCC. To say you focus on your business, whatever is a compliance here, whatever is your accounting, monthly reporting that you need cost line items, you need what is the breakup, you need cash flow monthly that's happening in India, everything can be handled by us. Believe me when I say this, even for a seater of 500-600 people, this is not a very complex matter. Because it does not involve the amount of outside transactions that you think a 500 member team would have. Their revenue simply is 12 line items a year. You do monthly one, build up the cost, add a cost plus, send it out, one invoice, one payment. If your debtors, revenue, collections entry is one a month, imagine the amount of complexity that exists. So on all of these, I think on regulatory, on tax compliance, on accounting compliance, even if you're not set up, even if you're not helping on the operations side of the GCC, just purely as having a client, a one-stop shop, is an offer that is very easily doable. This is the point I made on company versus LLP. Flexibility, no difference. Access to varied instruments, yes, LLP has a limitation because a lot of bank lending is difficult in LLP, normal pure loans are difficult, that's the only difference, which is access to foreign debt, etc. But otherwise, if you look at efficient cash upstreaming, LLPs have a clear advantage because of a single stage taxation. AMT, MAT liability, again, Once you opt for a new rate, there's nothing that you need to do in the company regime. LLP, yes, there is AMT, but today there are no tax holidays, so that also is academic in that sense. Operating flexibility, LLPs give huge operating flexibilities. From a company law filing perspective, what needs to be done, the cost of compliance, audit, all of it, LLPs are significantly easier. What are the tax considerations which are there? This is something that I discussed, but I just put it up on one slide here. Companies will effectively end up paying 25.17 based on the lower tax regime. Forget the MAT and all that. Once we opt for lower tax regime, there's no question of MAT. The reason I put this is some of the earlier GCCs which are operating, which has SEZ benefits, are still operating under the MAT regime because they have built up a lot of MAT credit that is there, which has not been utilized. LLPs, again, 30%, effectively 34.94, but nothing more than that on dividends. Whereas if you look at dividends from a company perspective, there's a 20% plus dividend rate that will come in again on top of 34. So I've just done this comparison, the same one that I laid out a few minutes back verbally, but if you just see it, it will be very clear. 100, and you have company, just focus on the second column first. 25 rupees 74 is left, and then if you declare that as dividends, there's 11 tax on that. Therefore, you have effectively paid 36.39. What is left in the shareholder's hand eventually in US is 63, whereas it will be 65. There's a good 2% saving in the LLP. On big numbers, as they move up, 2% is a huge saving on the top line. Transfer pricing is one significant area where a lot of the GCCs are today having a trouble having litigation. This is the only area possibly where they are having tax litigation. Now, what is important is as we get in, and this is where as advisors or even as in-house finance team, etc., we have a role to play, is having that intercompany agreement which is aligned to the functions that the GCC is doing. Today, a lot of the GCCs like to put out that we are into, AI, ML, machine learning, artificial intelligence, etc., all of which lead to higher profit markup under transfer pricing. Therefore, analysis of the functions that is performed, what should be their margin, comparability analysis, etc., need to be done. Most of the GCCs are cost plus remunerated. That's a clear thing. IT, ITS, again, safe harbor, APA, safe harbors for software development, business support services between 17 and 20%. The rates have just been notified even as applicable for the current year as well, for 24-25. Then looking at APS is also a possibility, again depending on the size. APS are getting concluded at 14, 15%, 16%, thereabouts, depending on the nature of activity. But depending on how big the scale of operation is, APA may or may not make sense. Cost base and components, this is one aspect where there's some litigation that's happening. Whereas how do you compute the cost base for a GCC? If 100 is the cost incurred, do you take the 100 as the cost incurred and mark it up by 15, 16%, whatever is the profit margin that needs to be there? Or what happens for assets which are provided free of cost, for instance? A lot of these GCCs are today provided servers free of cost, especially entities which are into testing, for example, are provided a lot of equipment free of cost by the parent company. The position that the income tax department is taking is very interesting. They are basically saying if you have got it free of cost, then that's your income. And they are adding it under 28(4) of the Income Tax Act to say that this is a benefit that is accruing to the business. Therefore, the value of the asset needs to become income. What is happening in APA is they are taking a more pragmatic approach. I would say, in my view, a correct approach. They are basically saying if you are being given this asset free, that doesn't mean that becomes your income. But what happens is the asset that is given to you free is actually reducing your cost base. Because had you purchased the asset, then it would have been your capital, and therefore there would have been a cost to it. And what would have been the cost? There would have been a depreciation that you would have charged. Therefore, your cost base instead of being 100 would have been 120 or 130. Therefore, what they're doing in APA is they're adding a notional depreciation for the value of assets received. And therefore, you need to see how you will treat this, etc. There is a good amount of role in terms of advisory that each of us can play there. There is a similar position that the income tax is taking on other costs like tools, IT assets. You give access to certain common softwares which can be used, timesheets, productivity enhancement tools, trainings. There are companies which have taken a global license under LinkedIn and then they are available for all employees, and then Indian employees also participate in the LinkedIn training, but there's a fee paid in the US for global number of employees. Therefore, the right thing to do there is to actually ask for a cross charge from the US for that amount, because unless you record the cost at full value in India, there's a base erosion in India. The Indian government is not getting tax on that because your absolute profits are lower once the cost is lower, because you are operating on a cost plus. Therefore, common costs, shared services, ESOPs. Indian employees of GCCs are getting ESOPs of the listed company in US. Then there will be a ESOP charge that will be there. On the ESOP charge relating to the Indian companies, can there be a cross charge to India, which India records, and there therefore that cost comes in. There are other tax considerations. One significant one is, does any of these activities create a permanent establishment for the global company? I talked a while about vendor team sitting here. If they engage in negotiations, if they are concluding contracts, does that create a permanent establishment? If there are customer discussions happening, there are companies in India which are doing marketing and support services in India. Marketing support services, MSS as we call, is a very common segment in Bangalore companies. If you see any of the Bangalore tribunal, you will see MSS as a segment. So what they do is prepare documents, collaterals, look at fairs that the US company can participate in, explain product features, prepare brochures for product features, flyers for product features sitting in Bangalore. Do any of these create a permanent establishment for the foreign company in India? What it really boils down to is the amount of documentation that we have. And always what documents you have when the transactions are happening is worth 10x more than documents which get created when it is questioned, or confirmations and other things which are obtained during the assessment process. Therefore, again, huge role in my view for practicing chartered accountants on an advisory piece here on what should be the documentation, how should agreements be drafted. Yes, you are running a GCC, but can we see all your internal documentation? Where do your people report into? Because the income tax department on this has been extremely active. They have looked at LinkedIn profiles. There's a famous GE case, you can look at it, where they have actually downloaded the LinkedIn profile of an employee to say that that employee had put up on the LinkedIn profile that he's got some 2-3 patents and for his work. So the department actually said, because the Indian employee in a contract research, a GCC which does research and development, is actually getting the patent, a portion of the royalty or the patent income that is earned by the US company should be attributed to India because the development has happened in India. Now, we've helped companies clean up, review LinkedIn profiles of employees to say, how can we get them to reflect what's actually happening? And there's a thin line there, because companies don't want to be advertising as doing back-end work and therefore hire people. They want to advertise as doing research and therefore attract good talent. But at the same time, there's a thin line to say if all research work is done in India, then you have a higher risk of higher profit attribution or permanent establishment in India. Therefore, in the research development life cycle, what are the activities which are being in India? What is being done in the outside India? How do you capture the risk? How do you capture that process? Becomes extremely important. Secondment arrangements are creating issues again, which is none of these GCCs or a lot of these GCCs can't operate by themselves in India. So a lot of the times senior employees get seconded to be acting as supervisors, supervise activities that are being done in India. They come on a deputation for 1 year, 2 years and things like that. there were issues on whether that reimbursement of secondment income becomes liable to tax in the hands of the US company or not, whether there's a GST liability. Some of these are settling. There are a few Bangalore tribunal rulings which say that this should not be liable to withholding. GST, there's also a clarification that it should not be subject, of course, to certain conditions, and therefore should we be looking at those things. Indirect taxes, again, exports are zero rated, claims of refund that is there, another opportunity for us. So just to sum up, I thought I'll just put what I think are some of the large opportunities that could be there for us, whether, like I said, as practicing chartered accountants or being in the industry. One is the whole advisory piece, like I said, you know, on any of these things, which is operationalizing the structure that is there, the documentation that needs to be maintained, clauses of the agreement, etc. Operations. A lot of these GCCs, particularly finance GCCs, I've seen are being led by people who've been in the industry in the past. People who've been CFOs, people who've been controllers, people who've been finance managers, running particular finance processes, etc. Where you today can scale up and run a center for somebody based on that, instead of just acting as an in-house finance person. I've seen a lot of operation heads of GCCs being from core roles. Finance roles, again, within GCCs, actual finance role, accounting, etc. GCC leaders, multiple GCC leaders that I am aware of come from accounting background. The bot model is a huge opportunity, according to me, for chartered accountants who are, like I said, have the entrepreneurial skills, can actually work out a clear business model to a client to say, I can set up a center for you, run it, and then hand it over after a year and a half, etc. That's a good opportunity. Of course, the usual audit and compliance remains for all of these. If there are 1500 GCCs, those are becoming 1900, there are GCCs springing up everywhere, then that clearly is a next area of expertise, business, etc. as a sector that will open up for each of us. This is sort of what I had, like I said, more from a very practical thing without getting into any technical tax, accounting, etc. Any questions, happy to take, otherwise I think we can sort of wind it up. We have another 10-15 minutes if there are any questions.